Now let me introduce you to the concept of mutual fund. Okay, before that, I just want to share an important strategy in investments is to diversify. So meaning you need to not put all of your eggs in one basket, but you spread it. You spread it in many different instruments. So when you spread in many different instruments, your return will be more stable. It's less volatile because it's not dependent on just a small number of instrument. Okay, mutual fund is basically a pool of fund, and it is managed by a fund manager. And this fund manager will actively trade the assets in the fund to outperform the investment return at random. Okay, so investors will buy shares or units of the fund and receive pro rata share of earning. Have you heard the word unit trust? So this one that I discuss with you now is mutual fund, but there's also another concept which is called unit trust. Unit trust is also a pool of assets. So mutual fund is also a pool of assets, but the concept is actually different between unit trust and mutual fund. Unit trust is a trust fund. So the difference, some common difference between the two is as follows. The asset is basically for mutual fund. The asset is actively traded, means the asset keep on changing. Maybe today the mix is as such, tomorrow maybe it's a different, because they actively trade the assets. For unit trust, the assets usually is the same asset from the start of the trust fund until the end, until the maturity. So fixed asset. The maturity, mutual fund doesn't have maturity. As long as the fund still have customers, still have investors, the mutual fund will continue. It doesn't have maturity date. But trust fund, it have. So when it starts from a certain date until a certain date. Number of units, basically unit trust is fixed. So when they first start the trust fund, they have 1,000 units, let's say. So it will always have 1,000 units. If other people wants to buy unit trust, they will buy from other owners. So you just change hands, but they don't add more units. For mutual fund, it varies, depend on the demand. If there's more demand, there will be more units. Less demand, less units, something like that. So yeah, if you see, these two have some differences, but yeah, both of them are a pool of fund. So for mutual fund itself, there are different mixes of the investment assets. So the assets in the mutual fund varies. Some mutual fund consists of just bonds. So that usually is considered a safe mutual fund. Some consist only shares. So that usually is considered as a more risky mutual fund. And some is in between. It's a mix of everything. So and also there are some that have properties and any other investment instruments. So as an investor, when you want to choose the mutual fund, you will think about your investment goal and also your risk appetite. So yeah, there's also another type of mutual fund which is called index funds. Index fund is passively managed. Okay, have you heard of an index? What is an index? Index is a measurement technically, right? A benchmark. So in most countries, there are a lot of stock indexes where they want to measure the performance of the many stocks in their market. So have you heard of KLCI? So that is the measurement of the performance of stocks in KL. What about S&P 500? So that is the measurement of the stock of the top 500 in the US, or NASDAQ, or Dow Jones Industrial Average, or Financial Times Stock Exchange, FTSE 100. So all of those indexes are a measurement of the performance of the different stock markets. So these index funds are technically mutual funds that include the stocks that is included in these indexes. So it just replicates the composition of these indexes. So the weights also, they follow the weights of the actual indexes. So that is why this is called a passively managed mutual fund. So yeah, we're done with mutual funds. So now we go a bit on the fixed income investment. So as I said, fixed income investment will have zero coupon bond. An example of zero coupon bond is the Treasury bill. In Malaysia, our zero coupon bond is called Malaysian Treasury Bill, or MTB, or the Islamic version is MITB. So this is issued by the government, Malaysian government. Early withdrawal is not allowed for the Treasury bills. And if you want to sell early, you trade it in the secondary market. Okay, the deposits are insured by the FDIC in the US, but in Malaysia, our deposits or our investments is insured by PIDM. For the T-bills in Canada and the US, they have different quotation basis, right? For US, they use D, and for Canada, they use I. This is just the quotation basis of their yield rate. We covered this in lecture 8. Okay, now we covered Treasury bill. Now Treasury notes. Treasury notes usually are coupon bonds, not zero coupon bonds, and their maturity term is longer. So again, it is an IOU certificate issued by the government. Okay. In Malaysia, we also have Treasury notes, similar concept, issued also by the government of Malaysia. We call it MGS, Malaysian Government Securities. And the Islamic version of it is GII, Government Investment Issue. Okay. This one is issued by the government. Bank Negara also issue their own coupon bonds. So it is called the Bank Negara Monetary Notes. Okay. Certificate of deposit. So certificate of deposit, it functions like the zero coupon bond, but the difference between certificate of deposits and the zero coupon bond is who is the issuer. Certificate of deposit is issued by banks.